to you all students. Good day to you all students. You're welcome to the accounting class. My name is Mr. Michael Moore. The spelling, Mr. Michael Moore. But I would prefer you call Mr. Michael because most Yoruba people tend to get his name wrong. But today we'll be going into accounting and we'll start with the introduction. Now you may ask, what is accounting? That is the first question. What is an accounting? And the second, difference between accounting and bookkeeping. Now, I know some of you are already aware of what definition of accounting. You must have heard of the long definition, like accounting is the process of recording, classifying, selecting, measuring, communicating of financial information to users to enable them make assessments and decision. Now, that's a very, very long definition, but we'll be looking at each aspect. Recording, classifying, selecting, measuring, and communicating. Now, what are the ways of recording accounting, you may ask? Let's give for instance, you have bought an asset worth, let's say, 20,000 naira. Now, how are you going to record this? You may come, there's what is called balance sheet, which we'll still look at later. In the balance sheet, we have the asset side, and we have the capital and the liability. Now, where do you think this recording will come under? Let's look at it. Bought an asset worth 20,000 naira. They never specified whether the asset was bought on credit. So therefore, we will assume this asset was bought on cash. But assuming this particular statement told us that check was involved, we would have not been looking at cash, we'll be looking at bank. So please take note. These are the little things you should take note. Now, we'll come under the balance sheet, and under the assets, 20,000 naira, we'll put asset because there are two types of assets, fixed assets and current assets. Under the fixed asset, we'll put the 20,000 naira. Then, that should be a plus there because the asset is being added. Then under the asset, current this time around, we will minus 20,000 naira. This is a good example of what? Recording, classifying. Why did I say classifying? We classify the asset into what? Two types. Fixed asset and what? Current asset. So that is a classic example. Then the third one is selecting. What do I mean by selecting? Not all information are selected to be recorded. Let me repeat. Not all information are selected to be recorded. Why did I say so? There are some information that don't have monetary value. There are some information that don't have monetary value, even though they impact the business. But since they don't have monetary value, you don't select them to be what? Recorded. Then measuring, that is another key area. How do you measure? You measure accounting information based on price, which is measured in, maybe in our own case, naira. In another country, it could be dollars, it could be pounds. Then communicating. Now, this is the essence of accounting. Why did I say it is the essence of accounting? You may have all these recordings, all this measuring, all this classifying, everything. But if you don't communicate, or you communicate, but you don't communicate properly, all this financial information to users, all these things you are doing is as good as being useless. Why did I say so? These users make use of all this information. And what are the information they make use of? E.g., the main key information these users make use of is what is called bottom line. That is a popular saying. They will tell you bottom line, bottom line, bottom line. But do you know what bottom line is? They are talking of your profits. In many cases, net profits. So please take note. Communicating is the main essence of what? Financial accounting. And who are these users of accounting? As we go on, we'll look at each of them and we'll tell you why they need the what? Information. But please take note. The essence of accounting is what? Recording, classifying, selecting, measuring, communicating of what? Financial information to what? To enable you, the users, to make what? Assessment and what? Decision. Now, hope you got that. Now let's move ahead. We're going to look at what bookkeeping. What do you think bookkeeping is? Bookkeeping is just like, how will I put it now? Okay? Bookkeeping is just an aspect. Is an aspect of accounting. Why did I say an aspect? Accounting is a broader what? Activity. While bookkeeping is less broad. That means it is narrow. Narrow in scope. Why did I say it is narrow? Bookkeeping, from that word, bookkeeping, what do you do mainly? You do mainly recording, maybe classifying, and measuring. But a bookkeeper does not analyze. Why did I use that word, analyze? An accountant can take information such as what? Net profits and maybe fixed assets. And it will measure the ratio between this net profit and fixed assets. That means he is analyzing the what? Performance. But for a bookkeeper does not do that. What a bookkeeper does is just to record everything, classify, measure, then he will now give it to the accountant. It's the accountant now that will now prepare, analyze, and communicate, which is the main essence. Communicate these financial information. Gotten from who? Derived from the bookkeeper. So please take notes. What is the work of the bookkeeper? The work of the bookkeeper is just to what? Record, classify, measure. But he does not what? Analyze. So please take note. He does not what? Analyze. The accountant's own is just to what? Collect this information. Now package it as a whole. Prepare it. Analyze all the information so that the different users will know will get the information they require. Then it will now communicate this information to the who? To the final user. So this is the difference between a bookkeeper or bookkeeping and accountant or accounting. So hope you got that. Okay, very good. Let's move ahead. Now, who are these users of accountants? You mean users of accounting information? Now, users of accounting information. Let's look at the first set of people. The employees. These are internal members. Let's classify the users to internal and external. Apart from the employees, who again? The management. Apart from that, who again? The shareholders. So please take note. The internal users of accounting information are who? The employees, the people who work for the company or the business. The management, that is those ones that prepare and make available this financial information to the final users. Then the shareholders. Now, what are their various interests, you may ask? Let's look at the interests of employees in the financial information. Interest of employees in financial information. Now, the first major interest of an employee is what? Is always after the profits. And why is it after the profits? To know if the business will be able to pay his salary / remunerations. That is the main thing it's after. Any other information, it doesn't care. It's always after this profit. To know what? To know whether the business or the company will be able to pay his salaries and remunerations. So please take note. Now, the second set of people we're going to look at, which is this number 2, are the management. Now, what is the interest of management in the financial information? The major interest of this management is to achieve its set targets, which is usually measured in profits. Why did I say so? Management usually have a set target, and this set target, which is usually profit, is measured maybe 1 year, 2 years, quarterly, which is 3 months, then semi-annually. Now, there is a positive and negative effect of this set target. What do I mean? Okay, let's say for instance, they are given a target of 2 million naira, that's profit, to be made in a year. When this management, let's say after 9 months, which is like 3 quarters, they notice that the profit is still well below 0.5 million, which is 500,000. The management can decide to do what is called selective or cooking up accounting information. Why are they doing so? They will try and manipulate figures in order to make their financial information to be reading 2 million naira. How can they do this? They can decide to increase forcefully. That is not that is not a true increase. They are forcefully manipulating figures. Their revenue Because they know once they forcefully increase their revenue, their profit will also increase. Or another way is they will decrease. Okay? Another way is they will decrease forcefully. You can take note of that word. I'm using what? Forcefully is not a true decrease of expenses. That means they will be hiding some expenses. They won't put it in their books of account. Or some expenses that maybe is like 1 million. They will decide to reduce it to like 600,000. And how can they do this? They will start hiding some source document, which we will still look at, so that it will look as if no transaction of that expenses appeared. Or they can start falsifying or falsifying figures. Falsifying figures in what? In their financial what? Information or their source documents. So these are the ways. Just to what? Just to achieve the increase in what? Just to meet up their set target. Now, those are for the management. Then the third set of internal people are the shareholders. What did I say? The shareholders. Who are these shareholders, we ask? These are simply the owners of the business. How are they the owners of the business? They buy what is called shares, which is just a unit of capital of the business. Now, due to their buying these shares, which is a unit of capital of the business, they are now called what? Shareholders, and they are entitled to what is called dividend. And they decide on this set of people that may continue or that may be hired. That means these shareholders have the power to either what? Employ or either sack or use what? Terminate anyone. Still the same thing we're saying. Terminate this what? Management. So how did they do that? How did they decide this type of how did they exercise this their what? Their power. Let's say it's a power. They look at the financial information. And what are they always after? The first thing they are after is profit. And usually net profit. Hope we'll still get to know the difference between gross and net profit. But usually it is the net profit they are what? After. Then once they take note, another thing they are always looking at is the assets. The assets of the what? Business, which include fixed and current assets. So please take note. Another thing they are after is the liabilities or capital. They want to make sure that the liabilities of the business is as low or reasonable as possible. So please take note. This is just their interest. Then they are always after the ratios, which we will still look at later as we progress. What are the ratios they look at? Profitability ratio, liquidity ratio, and so on and so forth. So those are the what information they are after. So take note, we have looked at the employees. What are the employees after? The profit. And why are they after the profit? To know whether the business will be able to pay their what? Salaries or remuneration in the current and future period. The management, what are they also after? Profit. To make sure that they what? They meet their set targets. They meet their what? Set targets. And their set target is usually monthly, yearly, quarterly, semi-annually. Then the shareholders, which is just what we explained. Now, we're going to look at the what? External users. Who are the external users, you may ask? have the government. We again, the public, the general public. We again, interest or pressure group. We again, the tax and other government agency. We again, the creditors, very important people. Creditors / debtors. Now, let's look at the government for instance. Why would the government be interested in financial information? Government, the main sole aim of government interested in what? Accounting information, is to find out if the business can survive or how large the business is, large or size of the business. Why is government concerned, you may ask? There are some key sectors of the economy or business that the government cannot afford to let down. What do I mean? E.g., for instance, a good example is maybe in the telecom sector, Glo, which is a Nigerian company or business operating. Then in the banking sector, financial sector, e.g., First Bank, which other ones? Okay, Zenith, which other ones? There are many bigger banks. GTB. These are banks that the government cannot afford to go down. Now, how do they know whether they are surviving or they are still big or they are still contributing as they should contribute? They go through what is called their financial information as recorded in their P&L. P&L means profit and loss account, and their balance sheets. These are the two main sources of financial information. So please take note. The main aim of the government is to find out whether the business can survive or the size of the business, and to know how to. Now, all these things, finding them out is for two reasons. The first one is to know the size and the situation the companies, these businesses are operating. That is the first thing. Then the second thing, after knowing this, is to know how much or how the extent to which they can assist, who? They can assist these businesses. So that is just the main aim of the government. First, they find out whether the business is surviving or can survive into the future. Then the size of that business, is it growing or is it coming down? Then the two main reasons for knowing this is to know how their situation, are they operating well? Are they still good? Are they still getting what they should? Are they still providing what they should provide? Then, if they are having problems, they will now know how much or the extent to which they can assist those businesses. Now, we're going to look at the second set of people called the public. Now, these are external users of accounting information. And what is their function? Why do they look at the financial information? They look at the financial information to enable them know whether the business is contributing to the sustenance and well-being of its members. Now, how do they do that? There's what is called CSR. And what is CSR? Corporate social responsibility. What did I call it? Corporate social responsibility. Now, what is corporate social responsibility, you may ask? You must have seen some, let's say for instance, a stadium. You know, a stadium where they play sport activities, football, basketball. It may be constructed by a business, e.g. maybe MTN can decide to donate some amount of money to who? To a community. It could be, let's say for instance, there's one at, as if you are going to Oshodi area. Now, there's but Oshodi, as you are getting to Oshodi before, Bagata, yes. There's a sport complex there. If you watch the name, you will see the bank that donated what? Sport complex. That is a good example of what? Corporate social responsibility. Now, all this corporate social responsibility are usually documented in their what? In their financial statement. And what are their financial statements? In their profit and loss, what? Statement of profit and loss account, as they call it now. There's statement of financial position, which is known as the balance sheet. So these are the ways, this is the main interest of the public. Is this business sustaining its what? Members or the public or the environment? And how is it contributing to the what? To the well-being of its members? Taking notes, okay? Let's go ahead. Now, the third set of people in the internal users are the interest or pressure group. Interest or pressure group. Now, what is the interest of pressure groups or interest groups? Now, you might have seen all this save the environment, bring back our girls, all those things. Yes, you must have seen it. Those are good examples of interest or pressure group. Now, what are their aims? They have a specific aim or specific interest. And what is, like for example, save the environment. What should come to your mind readily? This set of people, they are usually against what is called gas emission. And what is gas emission? Those gases that those industries or those big businesses emit into the environment. So, then this set of people, you must have heard of Chibok girls and all those things. Those are examples of what. But let's look at this. Let's leave this out. Let's look at this. Why are they interested in gas emission? Gas emission brings about what? Sicknesses to the environment or to the people, to the public or members of the public. Let's put it like that. To members of the public. So please take note. How would they know whether what? Whether a business is what? Is acting to their interest? They will look at their financial statement. And in the financial statement, there's a section that they always have, all these big businesses, they always have maybe sustenance accounting or responsibility accounting, whatever name they put it. Now, what is the essence of this accounting? They will account for how responsibly they derive their resources from the environment. And what do I mean? For instance, if you are into furniture, definitely where will be your resources, your source resources from? From the forest. You need to what? Cut down all those timbers, all those wood, then bring it to the what? Where they will process it and all those things. So if you are cutting those trees down and you are not replacing it, what is happening? You are not sustaining the what? Environment. That is where people like all these groups will come up. They will attack you that why are you not doing things? Why are you not making plans or strategy to what? To conserve or to sustain the environment? Or it could be in another way. Maybe your business involves what? Emitting gas. They will now check whether you have what? Some key strategies or some key areas of you controlling those what? Gases you are emitting. Once they see in your what? In your financial statement that you don't care about that, all what you care about is making profits, So this set of people, they are not after your profits that you're making. They are after what? Are you sustaining the environment? E.g., where you get your resources from, are you making sure that there is a sustainable plan that you keep what getting and regenerating those resources? Or how are you discharging your what? Responsibility? Are you discharging it irresponsibly? What do I mean? Emit gas into the air. At times you pour chemical into the water, as you experience in the Niger Delta area, where all these oil companies do their this thing. So these are the what? Interests of these interest and pressure groups. These are the interests of these interest and pressure groups. So please take note. What are they after? Just to make sure that what? You are in line with their interests. It could be that what? They want you to sustain the environment through what? Making sure that the resources you get, you sustain it, or you don't emit gases or chemicals into the environment. Then this next set of people, tax and other government agencies. Tax and other government agencies. Tax and other government agencies. Now, what is the essence of this tax? Their main aim, what they look at is profits. Profit, that is what they're after. Now, why are they after your profit? Usually, your net profit. Why are they after your profit? They want to know the extent to which you pay your tax. That is, how pay your tax. Or the level of tax you should pay as a business. You should pay as a business. So please take note. This set of people, what is their interest? Their interest is to make sure that what? You pay your tax. That is the first thing. Or you are paying the appropriate level of tax. E.g., somebody earning 25 million naira as profit. His tax is not supposed to be the same with somebody earning like 20 or 15 to 20 million naira as profits. So that is what they are after, because they know many businesses cook up their accounts. Cook up their accounts. They are very aware. So that is why they scrutinize your account to make sure that your revenue is supposed to be as it's supposed to be. Not that you be manipulating revenue, making your revenue to be lower than what it is. Then they will make sure that your expenses is what is supposed to be as what. Let's say, for instance, your expenses should be 5 million, but you went to manipulate it so that your profit will not be high. You manipulated it to 2 million so that your profit will be lower than what normal by 3 million. That is all those things they are after. Tax. That is their own main aim. Then the last set of people are called creditors. Creditors or debtors. Creditors / debtors. Now, what is the aim of a creditor checking your what? Financial information, you may ask. The main aim is one, aim of creditors checking your what? Financial information is to make sure you can pay back. That is the first thing. Pay back any loan or advances lent out or advances lent out to you. That is the first aim. Then two, your capability to pay back. So what they are always after is pay back. Can you pay back what? Our loans. Pay back any loans / credits lent or about to be lent. So that is their major aim. To what? To make sure that you can pay back. And how can they find out? They will now be looking at your liquidity ratio. There are some ratios. How liquid are you? We'll still get more into that. Then they will look at your profitability ratio also. So please take note. That is the main aim of creditors. To make sure that what? You can repay back the loan and advances. And the second one, do you have the capability of paying back? Somebody earning a profit of 2 million naira, definitely the creditor will not want to give him a loan. Let's say it's earning 2 million naira every month. The creditor will not want to give him a loan of 50 million. No, that does not make what? Financial sense. Why? It will take this person 25 months to pay, which is a long period of time. But if the person is earning, let's say 5 billion naira, that is a profit every month. Now, if the creditor wants to lend 50 million or more, depending, it will be more comfortable because he believes this person has the ability to pay compared to who? To this other person. So that is their interest. Can this person pay? And even if I give him, will he be able to pay? That means they will check the long term, maybe for 5 years. Have you been making profit consistently? And how much is your profit? So that they'll be able to know whether what you can be able to pay if they give you a short or a long term advances. So this is what we'll round up for today. We'll still see later as time goes on. Thank you.